That's quite a statement to say, no expansion, slowing the pace, dampening risk appetite, stifling growth. Is it really as bad as that?
It's not as bad as that. I think the South African insurers are quite positive, in fact, about their growth prospects. So while this is all happening, we see a lot of optimism around growth, and there are new opportunities for that.
Just give us the context for the survey. You don't do it every year, it's every 2 years. So
yes.
In that sense, it has a scarcity value, which makes it more interesting. It's not a monthly survey. How do you do it?
We do it with an independent interviewer who goes out to across the industry, mainly to CEOs in the long-term insurance industry, short-term reinsurance companies, cell insurers, so right across the board, and also spread around the country. So we get discussions in Cape Town, Pretoria, Johannesburg, to try and cover as much of the industry as possible. So that's done once every 2 years, typically in February, March, with the release now in June. So it's quite a long process, but we try and get the views from across the industry.
One of the areas where you try to summarize is you talk about the drivers of change facing the industry, and that's obviously identified by these people you talk to. Capital requirements, well, that would seem to be obvious. Consumerism, and then two new drivers you say are demographics and internet and mobile technologies. What does demographics mean in this context?
Demographics is the changes that we're seeing in populations. First of all, you've got new middle class, rising middle class. In South Africa specifically, it's a rising black middle class, obviously with new buying power. So that's an opportunity in a sense that you can sell insurance to a different group of people. Then you've got, at the same time, aging populations, where you've got now a new development, if you like, mainly in Europe, on longevity. People are living longer, where the normal retirement age would have been 65. 10, 20 years ago, people now live as long as 80 in some cases. And there's a big question as to whether the retirement provision is adequate. So new opportunities for insurers to fill the gap.
Because the actuaries have to work hard at this. They now say that you can live as long after you retire as you worked. Yes. 35 years, and maybe you live for another 35 years. It's becoming increasingly likely, and the insurers have to adapt to that. What about internet and mobile technologies? Because to me, as an outsider, this may be the biggest thing happening, because it happens so fast, and increasingly you just go online and you buy insurance.
Yes, particularly among the younger generation, but it's all about access and the ability to get to products as quickly as possible. So the consumer in particular demands speed and efficiency in buying insurance. They are no longer patient with waiting for a broker to come to them with paperwork, fill in forms, and then you eventually might get a policy document a month later. They want speed, and they want it there and then. So what the mobile explosion, if I may call it, is doing is increasing access from remote locations, and also getting to people that were previously not accessed by insurance. Rural communities, for example, people sitting in taxis in our own environment can actually buy insurance on their mobile phones as they go home. Young people sitting in classrooms or boardrooms or wherever can actually play around with their tablets, mobile phones, and buy insurance. So that's where the revolution is coming from, increasing access, basically.
What about the trust aspect? Because insurance is a bit of a grudge purchase, and you also want to know that it'll pay out and that there won't be issues. And maybe the face-to-face encounter is still important for that. I saw one of the insurance companies, I think it was Etana, there was a poster saying, what about the handshake? You know, it's all very well having the technology, but you need the handshake.
Yeah, you will still have intermediated models, particularly on investment products where you need advice in terms of your choices, and some of the more complex products, particularly on the life insurance side. But your commodity type products, particularly in short-term insurance and so on, funeral policy insurance, for example, can be accessed on the internet, and you don't need a lot of advice in those areas. Well, the other aspect to look at is price. Young people like to be able to access different providers or carriers and compare prices very quickly. For example, get 6 different codes very quickly on the mobile phone, and that's the basis of choice. So what you're finding is that your loyalty to brands or to certain intermediaries is being replaced by price choice.
Although you still need to trust the brand, that the cheapest one is not always necessarily the best. What about regulation? I mean, this becomes a whole industry within the industry. Something called the Twin Peaks model for financial regulation. What's this?
Okay, if I may just look at what's happening there, what you have now is a combined sort of regulatory framework for insurers and a combined one for banking institutions. What the industry, the financial services industry is doing and the regulators are doing is combining that and then separating the prudential aspects, which include the capital requirements, under one umbrella, and that's the prudential supervision umbrella, and then also the market conduct framework under the treating customers fairly framework, and that's going to look at market conduct, consumer protection, and so on.
But is the industry unhappy about this because it's more work, more complication?
Not necessarily. I think it brings its benefit. What the industry is saying is it won't necessarily improve access to insurance or financial services products, and it might not make them cheaper. But they realize their benefits, and it could actually strengthen the financial supervision in this country.
Are costs going to be driven down by the technology and by increased regulation, or does the extra bureaucracy mean more people and more costs?
I think we've got to separate those two. The cost of implementing Solvency II or SAM, as we see it in South Africa, is significant. There's no question about that, and that comes across in the survey as well. If you look at the lower end of the spectrum, the short-term insurance companies, for example, are looking at anywhere between 25 and 50 million in total costs to implement SAM and TCF and all these other ancillary changes. Then you've got a middle tier ground from about 50 to 200 million in the long-term space, and as high as 800 million for the bigger long-term insurers.
So is this something
so it's quite significant, but that's spread over a period of time, and you've got to look at the implementation period. So there's a lead-up period to about 2015 where you accumulate these costs.
From an investor's point of view, I mean, there are lots of insurance and investment combined companies that are investable. Are these costs and these issues going to affect investors?
I think they will strengthen the industry. That's the one side, and they're not going to go away. This is a global trend. So if you want to invest in financial services anywhere in the world, you will have these costs. But you've got to realize there are benefits that come with the costs, like strengthened risk management, strengthened and more efficient processes, which hopefully would reduce costs. And then there are the direct channels that are coming with technology, and hopefully that will reduce some of the distribution costs. But on the other hand, you've also got to think about marketing costs and other things that come when you've got direct channels.